All right, welcome. Today, we're diving into something that's really at the heart of any deep financial analysis: ratios. We're going to explore how Finmagine's Ratios tab helps you take what looks like just a sea of numbers and actually turn it into a compelling story about a company's real health.
So, let's start with the big problem, right? The one that every analyst runs into. A single financial number, just by itself, is pretty much meaningless. It's the context around it that gives it any power.
I mean, think about it. If I just told you a company has a capex to depreciation ratio of 2.59, what does that actually tell you? It means they're spending almost 2.5 times more on new stuff than their old stuff is losing value. Is that good? Is it a sign of aggressive, smart investment in the future? Or are they just burning cash inefficiently?
Exactly. Without context, it's just a number floating in space. To know if that 2.59 is a hero or a villain, you need to know what the trend looks like, how it stacks up against direct competitors, and what's even considered normal for that specific industry.
And that is exactly where the Ratios tab comes in. You can think of it as your own personal quantitative analysis engine. It's designed to give you all that missing context in an instant so you can stop guessing and actually start analyzing.
Okay, let's jump right in. The first thing you see when you land on the Ratios tab is this All View. This is your 30,000-foot scan of the company. It lays out over 30 critical ratios, everything from profitability to leverage, and lets you instantly see the big strengths and, maybe more importantly, the big potential red flags.
And the very first layer of context is this brilliant, super simple color coding system. You don't even have to read the numbers at first. If you see green, that's excellent. We're talking top-of-the-class performance. Blue means good, healthy, solid. Amber, meh, it's average, kind of middle of the pack. And red? Well, red is your signal to stop and pay close attention. It means something's below the acceptable level and definitely needs a closer look.
Now, the second layer of context is peer comparison. Finmagine doesn't just tell you if a number is good in a vacuum, it tells you how it stacks up against the competition. High in industry means the company is in the top quartile. It's doing better than at least 75% of its direct competitors on that one metric.
And this is where it gets really powerful. When you combine these two layers, you get these immediate, high-signal insights. So if you see a ratio that's colored red for poor, and it's flagged as low in industry, that's a double red flag. It's not just weak on its own, it's weak compared to everyone else. That's exactly where you should start digging. So, let's say you've spotted something from that main view. You can then click into a specific category, like leverage or profitability, to see these detailed ratio cards. So let's break down what's really inside one of these.
Okay, so here we are looking at the leverage category. You can see right away with the green and blue borders. That's our first clue that this company's debt situation seems pretty healthy. But let's zoom in on the anatomy of one of these cards to see exactly what it's telling us.
Each card is like its own mini dashboard, packed with 6 key pieces of info. You get the border color for that instant health check and the actual number right up front. But then you get the trend spark line, which shows you the direction of travel. Green bars mean it's improving, red means it's getting worse. And this is super smart. For a debt-to-equity ratio, a lower number is better, so the system is smart enough to show falling numbers with green bars. You also have the peer percentile, the exact formula for total transparency, and the specific threshold ranges so you know precisely what it takes to be good or poor.
Now, beyond all the standard ratios, we can go even deeper with some advanced analytical tools. This is where we look at composite metrics and metrics that are tailored to the operational reality of a specific industry.
The Calculated tab is your next stop. These are some seriously powerful metrics that are computed on the fly. The absolute star of the show here is the DuPont Analysis. What it does is it takes return on equity, or ROE, and it basically cracks it open to see what's inside. It tells you why the ROE is what it is. Is it because the company has amazing profit margins? Is it because they're incredibly efficient with their assets? Or are they just juicing their returns with a ton of debt? This one analysis tells you so much about the quality of a company's earnings.
And that leads to this brilliant idea you can explore, the zombie test. By looking at a few key metrics, you can ask, is this company actually generating enough real cash from its operations to pay its bills? Or is it just surviving by borrowing more money to stay afloat? This helps you spot those financial zombies that look alive on the surface but are fundamentally broken underneath. It's a critical distinction.
Of course, all this is great, but a hospital isn't a cement plant and a bank is certainly not an IT company. Standard financial ratios can only tell you so much. What about the operational metrics that actually drive these very different businesses?
And this gets to a really important difference between financial ratios and sector-specific key performance indicators, or KPIs. While ratios like debt to equity test a company's financial health, sector KPIs test its operational health. They use metrics that are totally unique to that industry. Think of it this way. Financial ratios tell you if the company is well managed financially, sector KPIs tell you if it's actually good at its job.
And the platform is incredibly adaptive. If you're analyzing a hotel company, the tab will literally relabel itself Hotel KPIs and show you things like revenue per available room. Then switch over to a cement company, and that same tab automatically changes to Cement KPIs, showing you capacity utilization and profitability per ton.
And it goes on and on for other sectors. For hospitals, you'll see revenue per bed. For banks, where standard ratios really don't apply, you get a dedicated Fin KPIs tab with crucial metrics like gross non-performing assets and the CASA ratio. And get this, a lot of the time these operational numbers will show signs of stress long before they ever appear in the standard financial statements.
So, that was a lot. How do you pull all of this together into a smart, repeatable process? Let's walk through a simple workflow to get the absolute most out of the Ratios tab.
Okay, here's your playbook. First, scan the all view for any obvious red flags. Second, for any of those poor ratios, check the trend. Is it getting better or worse? Third, drill into profitability. Really focus on metrics like return on capital employed and return on equity. Why? Because they're often the best long-term signs of a high-quality business. Fourth, check leverage to understand the risk profile. Fifth, and this is so crucial, look at valuation last. You have to understand the quality of the business before you even think about the price. And finally, pop over to the Calculated tab to check for any hidden issues using composite metrics like the DuPont Analysis. So you see, when you follow a process like this, you move way beyond just isolated data points. You start to see the connections, the trends, the trade-offs. You're no longer just looking at numbers, you're reading a story. So the only question left is, what story will the numbers tell you?